Good morning, ma'am. My name is Sehman Kumar, and today I will be presenting on the topic roles and functions of the Reserve Bank of India. So, the Reserve Bank of India is the central bank of India, which began its operations on April 1, 1935, under the Reserve Bank of India Act. Reserve Bank of India uses monetary policies to create financial stability in India, and it is charged with regulating the country's currency and credit systems. Now, coming on to the functions of RBI. The first is monetary authority. It chooses the amount of money required to be delivered to the economy in order to improve the exchange rate, sustaining a good equilibrium of expense, achieving financial stability, regulate inflation, strengthen and support the basic banking system. The next is the issuer of currency. It has the only authority in India to produce currency. It also takes actions to regulate the passage of fake money. The next is the issuer of bank permit. According to Section 22 of the Banking Regulation Act, a bank is not authorized to start its function devoid of attaining a license from the RBI. The next is bankers to the government. It acts as financial both to the state and central government. It delivers short-term credit. It governs all the new matters of government lends, maintaining the government debt unsettled, and taking care of the market for the government securities. It counsels the government on banking and monetary subjects. The next is Bankers Bank. It is the bank of all the banks in the country as it delivers the loan to bankers slash banks, rediscounts the invoice of banks and receives the payments of banks. The next is financier of last resort. All the other banks can borrow from the Reserve Bank of India by keeping qualified securities as a deposit at the time of crisis or need. The next is banker and debt controller of government. It retains credits of government devoid of charging any interest, accepts and makes the compensation, carry exchange payments and aid to float new loans and control public debt. It also acts as a guide to the government. The next is money supply and regulator of credit. To manage demand and supply of cash in economy by open market actions, credit ceiling and much more. It has to meet the credit necessities of remaining banking system. It requires sustaining price stability and an elevated rate of economic growth. The next is act as a clearinghouse. In support of the settlement of banking deals, RBI governs 14 clearinghouses. It enables the exchange of devices and processing of the fee instructions. The next is controller of foreign exchange. RBI acts as a guardian of forex. It oversees and implements the facility of Foreign Exchange Management Act. It buys and retails foreign currency to conserve the exchange rate of the Indian rupee versus the overseas currencies. The next is regulator of economy. RBI manages the money supply in the system, tracks the different vital indicators such as inflation, GDP, and etc. The next is managing government securities. It directs investments in organization when they invest indicated minimal amounts of their total liabilities or assets in the government securities. The next is regulator and supervisor of expense and settlement structures. The Payment and Clearing Methods Act of 2007 provides the Reserve Bank of India oversight power for the expense and clearing systems in the country. It emphasizes on the development and working of safe, protected, and efficient payment and reimbursement of mechanisms. The next is development role. This part includes the development of the standard of the bank system in India, guaranteeing the credit is obtainable to the productive areas of the economy. It delivers the wide range of publicity functions to upkeep national objectives. It similarly includes establishing organization designed to shape the country's financial setup. It also supports in expanding access to inexpensive financial services and endorsing financial learning and literacy. The next is publisher of economic data and additional data. Reserve Bank of India preserves and provides all crucial banking and additional economic data, articulating and critically assessing the economic guidelines in India. It collects, combines, and publishes information regularly. The next is exchange manager and regulator. Reserve Bank of India represents India as an associate of the IMF, that is the International Monetary Fund. The majority of the commercial banks are certified traders of the RBI. The next is Banking Ombudsman Scheme. Reserve Bank of India presented the Banking Ombudsman Scheme in the year 1995. In this scheme, the accusers can file their objection in any form, comprising online and can similarly file a petition to the RBI against the grants and other verdicts of the banking ombudsman. The next is Standard Board of India and Banking Codes. To calculate the presentation of banks in contrast to the codes and standards centered on acknowledged global practices, the Reserve Bank of India frames the Standard Codes of India and the Banking Codes. The next function is Impartial Practices Codes for Investor. RBI frames the Fair Practice Code for Investor, which was conveyed to banks to protect the interest of debtors. All the banks are expected to trail the codes that are formulated by the RBI. Miscellaneous function can be Reserve Bank of India gathers, collates, and issues all the monetary and banking information frequently in its weekly system in the RBI notice and in the report on cash and finance. The next is the endowment of industrial finance. Fast industrial growth is vital to the growth of the economy. Providing satisfactory and timely acknowledgement to small, medium, and large business are very significant. The RBI has a key role in setting up distinct financial establishments such as ICICI, IDBI Limited, and Exim Bank, etc. Now, coming on to the objectives of RBI, the primary objective of the Central Bank of India is to control inflation. Inflation refers to a sustained rise in the prices of goods and services. It results in a decline in the purchasing power of people over a period of time. The Consumer Price Index and the Wholesale Price Index are the accepted instruments in India for tracking inflation. It measures the average price change in a number of commodities and services. For instance, a sudden decrease in the amount of oil supply leading to increased oil prices can cause cost push inflation. Inflation can occur when the cost of goods increases because of an increase in the cost of raw material needed to manufacture such commodities. Other reason can be if there is an increased demand in the market for some goods and services. Consumers will then be willing to pay even more for these products. Inflation can be viewed in both positive and negative light. It is viewed as positive when it helps to boost consumer demand and consumption. This influences economic growth by encouraging producers to produce more to meet the new increased demand. On the other hand, extremely high inflation can signal an overheated economy. It lowers the purchasing power of people drastically. It increases the cost of borrowing and reduces the employment. Inflation also encourages spending. The urge to spend and invest more at the time of inflation tends to boost it even further, which creates a potentially disastrous feedback loop. It disencourages saving and reduces economic growth by increasing the cost of living. This means that even as we save and invest, our accumulated wealth buys less and less with the mere passage of time. Thus, inflation reduces one's purchasing power and eats away at one's real returns on the savings and investment. Central banks use inflation targeting in order to keep the economic growth steady and prices stable. The Reserve Bank of India has set a target inflation band of 4% plus minus a band of 2%. By raising interest rates or restricting the flow of money supply in the country, the RBI aims to keep the inflation in check. A lower interest rate tends to result in more inflation. When the interest rates are low, individuals and business tend to borrow more money from the commercial banks. This leads to a smooth flow of money in the economy. The purchasing power of people increases and thus their demand for various goods and services increases. This leads to heightened demand for goods and in turn causes inflation. Conversely, an increased interest rate makes people borrow less, their purchasing power reduces, and so does the demand for commodities. This helps to keep the inflation in check. So, the next is steady growth. The next objective of the central bank is to ensure that the economy grows at a smooth pace. One of the ways to measure economic growth is to measure the GDP growth. GDP stands for gross domestic product and it is the total monetary value of all the final goods and services produced in an economy in a given period of time. A rise in GDP signifies a rise in total output. It is presumed that this output is sold in the market and exchanged for money. Hence, with the rise in total output, the corresponding income of household is likely to increase. A more accurate measure to use is the per capita GDP. The Reserve Bank of India aims to influence economic activity by using its monetary policies discussed previously. The central bank issues the flow of credit to the most productive sectors of the economy and hence keeps the engine well oiled. The, the next objective of RBI is also to maintain financial stability in the country. Financial stability can be defined in terms of a nation's ability to facilitate and enhance economic progress by managing risk and absorbing shocks. The financial markets and the various financial institutions are resistant to economic shocks. This stability is important because it represents a sound financial system. Rapid liberalization of financial sector and adequate economic policy, inefficient method of resource allocation and poor market discipline can be the factor for financial instability. A stable financial system is competent enough to efficiently allocate resources, assess and manage financial risk, and maintain the level of employment. A stable economic system absorbs the shock beforehand with the help of self correcting mechanisms. It refers to a condition in which the financial institutions are adept to carry out their financial transactions without requiring any external assistance, such as that of the government. Stability of financial markets enables economic agents to raise and operate funds freely. Stability of financial infrastructure is used to define a condition where the financial system works to ensure that both the financial safety net and the payment and the settlement system are running effectively. It is an essential condition as it ensures a healthy development of the entire economy. A credit rating company called ICRA Limited was established in 1991 to provide independent, well researched, and expert credit risk opinions to borrowers in relation to their borrowing activities. It is essentially the second largest credit rating agency in India after CRISIL. It provides rating, research, risk, and policy advisory services. A credit rating agency does research and analyze the financial strength of several companies and government entities. They help investors in identifying companies' ability to pay debts and to assess the level of risk involved. Now, discussing the role of RBI in the economic development, the Reserve Bank of India has a crucial role in the Indian economy as it makes or breaks the economy. The first is development of banking systems, development of financial institutions, development of backward areas, bringing economic stability, facilitating economic growth, preparing proper interest rate structures. The next is RBI's role in promoting schemes and policies. Announcing schemes and policies which profit the community as well as the government is one of the main functions of RBI. It includes promotion of commercial banking, promotion of cooperative banking, promotion of industrial finance, promotion of export finance, promotion of credit guarantees, promotion of differential rate of interest schemes, promotion of credit to priority sections including rural and agriculture sector, promotion of credit to weaker sections. The next is the supervisory function of RBI, providing authorization to banks and managing the number of new branches, doing a periodical inspection of banks, monitoring non-bank financial organization. The non-bank financial establishments are not inclined by the working of monetary policies. RBI has the right to give orders to the NBFIs regarding their functioning. The next is execution of deposit insurance scheme. To guard the credits of small depositors, RBI worked to devise the deposit insurance scheme in the situation of a bank failure. Now discussing the prohibitory functions of RBI. It cannot provide any direct monetary support to any trade, industry or business. It cannot purchase its own share. It cannot buy shares of any industrial and commercial undertaking. It cannot purchase any immovable property. It cannot give loans on the security of shares and property. Now talking about the RBI functions in general term. The first is monetary policy. It denotes the use of monitoring tools under the regulator of the RBI in order to control the accessibility, cost and use of cash and credit. The next is cash reserve ratio. CRR is decided by the RBI and the percentage changes every year. Bank needs to hold a certain amount of their credits in form of cash with the Reserve Bank of India. RBI follows CRR either to drain additional liquidity from the economy or to discharge additional reserves required for the progression of the economy. The third is statutory liquidity ratio or SLR. It is a sum that commercial banks are obligatory to maintain in the form of gold or government permitted securities before issuing credit to the clientels. The next is repo rate. It is the rate at which the Reserve Bank of India credits out cash to commercial banks. Every time banks face restraint of resources they can take from the RBI against their safeties. If the RBI surges the repo rate, deriving becomes pretty costly for banks and vice versa. As a device to regulate inflation, RBI surges the repo rate, making it more costly for banks to take from the RBI with the vision to limit the availability of cash. Similarly, the RBI will do the exact reverse in a deflationary situation. The next is the reverse repo rate. It is the rate at which the Reserve Bank of India is prepared to borrow from the commercial bank. If the RBI surges the reverse repo rate, it means the RBI is keen to give a good interest rate to the banks to place their money with the RBI. This results in a reduction in the amount of cash accessible for bank customers as banks prefer to credit their money with the RBI as it assures higher security. This obviously leads to a higher level of interest which the banks will claim from their clients for loaning money to them.